Bismillahirrahmanirrahim. Assalamu alaikum. My name is Nidarana. Welcome to my YouTube channel. First of all, please follow, share, and subscribe my YouTube channel. Today, our topic is a quantitative risk optimization of Markowitz model. Agenda: short description of Markowitz model and its consumptions, questions to investigate, normality of the asset returns, is it a math? Is Sharpe ratio still reliable? If not, so why? Extreme events and Sharpe ratio. Traditional Sharpe versus modified Sharpe ratio. Historical versus future portfolios. Which time series to use? The higher statistical moments in construction of the model are they positive factors in decision making. Short description of Markowitz model. Harry Markowitz and portfolio selection. Assumption of modern portfolio theory. Mean and variance analysis. Mathematics of Markowitz model. Diversification in Markowitz model. Capital allocation line and efficient frontier. The Sharpe ratio. Skewness cortices. Assumption of modern portfolio theory. Investors seek to maximize the expected return of total wealth. All investors have the same expected single period investment horizon. All investors are risk adverse, that is, they will only accept a higher risk if they are compensate with a higher expected return. Investors base their investment decisions on the expected return and risk. All markets are perfectly efficient. Harry Markowitz and portfolio selection risk and reward. Reward is defined by expected return of investment, where risk is the weighted average of the standard deviation of those individual components of investment, balancing risk and rewards versus consumer preferences. Capital allocation line CAL and efficient frontier. The efficient frontier is convex as a result of risk and return characteristics of the portfolio, which changes in a non-linear fashion as its components weighting are changed. CAL, the line connecting a risk free asset with the optimal market portfolio. The Sharpe ratio, a measurement for risk-adjusted return by William F. Sharpe, SP equal E into RP minus RF over sigma into RP, where E RP equal denotes the expected return of the portfolio, RF equal denotes the return on the risk-free asset, and sigma into RP equal denotes the standard deviation of the portfolio returns. The use is to measure portfolio performance is a higher Sharpe ratio implies a higher risk adjusted return for the portfolio. At equilibrium, the Sharpe ratio of the portfolio and the market portfolio are equal. E into RP minus RF over sigma into RP equal E into RM minus RF over sigma into RM, a well diversified pool of the market. Skewness and kurtosis. Skewness is a parameter that describes asymmetry in a random variable's probability distribution. In probability distribution of a real valued random variable. Normality of the asset returns. It is a math. The Jerku-Beda test is a goodness of its measure. It measures the departure of data set from normality. It is based on three parameters: skewness, kurtosis, and variance. The result of GBT test, the study on 5 different data types series resulted in strong rejection of normality hypothesis for daily, weekly, and monthly asset returns, as well as good level of confidence for injection of normality for quarterly data time series. Normality of the asset returns. Is it a math? Frequency distribution of assets return. This plotting system let us observe closely any deviation from a normally distributed sample. The and deviation from the expected mean is traceable. The tails are clearly supporting the arguments of non-distribution as the top of the distributions confirm it. QQ plot for asset return. The empirical investigation on four types of data time series showed deviation from normality and high kurtosis. Also, the slight skewed pattern is also observable. Is Sharpe ratio still reliable? If not, so why? Standard deviation is assets return is a parameter of Sharpe ratio which is based on normally distributed assumption. This is the source of dilemma. The extreme losses on two distributions with equal standard deviation. In Sharpe ratio, the traditional Sharpe ratio shows a higher change in compared to the modified version. The portfolio with positive skewness shows a constant development for both types of ratios since it considers skewness as a crucial parameter for portfolio construction. Bear in mind that skewness is a parameter for MVAR. The portfolio with kurtosis parameter shows the lowest change in ratios while it has a low level of diversification. It is not an investment alternative in this case, but the development of is obviously interesting for an investment manager. At the end, please follow, share, and subscribe my YouTube channel. Thank you. Allah Hafiz.